In this session, I'm going to look at the basic introduction to the income statement. We all know that the income statement typically contains the revenues as well as expenses. So, a list of revenues, a list of expenses subtracted to typically finally provide the net income. So, this is what is a broad composition of the income statement, and this information is collected over a period of time. So probably it is like all the revenues that happened during the current financial year, all the revenues during the current financial year, all the expenses during the current financial year, and the net income during this financial year. So it could be on an annual basis, or it could be on a quarterly basis depending on the requirement. The income statement is typically prepared. So over a period of time, whatever are the revenues and the expenses, those are typically taken care of as a part of the income statement. So that's the reason in some cases the income statement is also called as profit and loss statement, because the net income is nothing but the net profit or net loss that is going to come up after subtracting the expenses from the revenues. So otherwise also called as statement of earnings. What is that the company has finally earned? So that's the reason even we call it as statement of earnings, more commonly called as a profit and loss statement. So this is on a broader scale what an income statement is, but here comes the presentation or the reporting mechanisms wise, right? From a reporting perspective, here I have to look at IFRS, International Financial Reporting Standards. As per the IFRS, the income statement plus other comprehensive income, these two can be combined together and called as the statement of comprehensive income. Either they can be combined and created like this, or the income statement can be presented separately, other comprehensive income can be presented separately. So either of these presentation formats is very much acceptable. But yes, I need to know which format the company is typically presenting. Even a few other accounting standards like US GAAP also go with this kind of presentation mechanisms itself. And why do someone use this income statement? Who all can use it and for what purpose? As we know, the financial statements which are prepared by the company are majorly used by various stakeholders, and primarily they can be used by investors, or they can be used by some creditors, or they can be used by lenders, any different kinds of parties. There could be many other parties who could be using them. Probably the investors are more interested in valuation of the particular firm, so they will evaluate the profits, the losses over various years to finally arrive at the valuation of the firm. And probably from a lender's standpoint, their understanding of the income statement is to assess the company's ability to repay, ability to pay interest on time, ability to do a principal repayment whenever required. So the lenders would evaluate the income statement of the company from that purpose. Creditors would typically look at from the purpose of again the company's paying capacity. So is the company sufficient enough to pay back pay back for the raw materials or for any other credits the company has taken during the short term. So all these things are typically going as a part of the income statement. Now just trying to understand a little bit more in detail. Now as we know that income statement typically contains only revenues, expenses on a broader category, right? Revenues and expenses. So whatever something came from the sale of goods and services, whatever the amounts the company has obtained from the sale of goods and services which are as a part of normal operations of the business. So for an automobile company, the sale of cars, whatever is the amount that is obtained because of the sale of the cars, typically goes as a part of the revenues. But in some cases, these revenues can be adjusted. To the revenues, there could be some kind of adjustment that could be done, especially with expected returns because of warranty, because of defect. There could be some expected returns. Means if I have sold some 1,000 cars, I am expecting 1% of them, which is 10 cars, can typically come back, which means my revenue will not be for 1,000 cars which I have sold. I am adjusting it with 1%, which is an estimate that I am making, adjusting it at 1% of the vehicles that can typically come back, and finally reporting the net revenue. Instead of showing the gross revenue, generally I can show a net revenue which is adjusted based on the expected returns of the goods and services that I am selling. So on a broader scale, that is what consists of the revenue. Now when I look at the expenses, it is the cost that is typically incurred to generate the revenue. Whatever the company has incurred as a cost to generate this particular revenue. It could be cost of manufacturing that particular product, it could be cost of selling it, whatever the company has incurred as a cost during this process to generate this revenue, all of them get treated under the expenses. Broader cost of goods sold, direct costs that are associated with the goods that got sold, any other operating expenses that are there, administration, selling, marketing, all these things, any financial expenses that are there which are more associated with interest payments on the loans taken, and any other taxes, all these things go as a part of the various expenses. And all these expenses in the income statement, they can be grouped either by the nature. So there could be again something like depreciation. Now depreciation is a grouped by nature kind of grouping, because depreciation of plant, depreciation of machinery, depreciation of buildings, all of them are typically grouped into one single element on the income statement called depreciation. Or in some cases, it could be function wise grouping. When I say function wise, if I look at the finance expenses, all the various loans that have been taken in different forms, the interest that needs to be paid on all the loans is grouped together as a part of finance expense. Probably I call it as interest, but the interest for various expenses, or probably when I look at cost of goods sold, it's a cost that is incurred with respect to manufacturing that particular product. So in some cases it is purely based on function, the grouping. In some cases it is purely based on the nature, but some of the things which are directly expected to be present as a part of the income statement going to all these things. And from a presentation standpoint, it is expected that in a particular income statement, if I am preparing it, let's say for the financial year ending 2014, I need to even present the same data one for financial year ending 2013 as well. Now, these two, so whatever are the content, let's say the revenues, again different subheadings under the revenues, expenses, different subheadings under the expenses, and finally the net income. I have to present it for 2014 as well as 2013. But with respect to the presentation, either this way is also okay, where the latest is first and the earliest is next, or even this kind of a presentation is also okay. First the earliest year and then the latest year can very well be coming up. And from a few formats perspectives also, sometimes for expenses people generally show them as negative numbers, or sometimes people put them in parentheses. Any of these presentations are quite comfortable as long as expenses are subtracted from the revenues to typically come out to the income. Apart from revenues and expenses, we also see something relating to gains and losses also in the financial statements. So whenever I am seeing some kind of increase in benefit, right, when I am looking at some kind of increase in the benefit, either because of normal business operations, or non-normal business operations, whatever is the increase in the benefit that is coming up, that can be treated as a gain. Especially like, okay, I have sold off a machine. I have sold off the machine. Now there is a book value associated with the machine that is shown in the financial statement. I would have sold the machine in reality at the selling price. Now what we see is, we'll try to find out the selling price minus the book value. If it is positive, I'll treat it as a gain. If it is negative, I'll treat it as a loss. So this is a gain that is coming because of selling a particular asset. The same way, this is as a part of the normal business operation itself, because the machine which I have been using for running my business. Whereas when I look at some investment, I have bought the shares of some company, may or may not be from the perspective of doing a business, just for exploiting the pricing mismatch. So let's say I have bought the shares of some company, and now I am selling off the shares. So whatever the profit that I have got, that is a gain, but not from normal business operations. So all these gains, if it is from normal business operations, it could be treated as a part of operating income, operating gains. If it is from non-normal, I can very well treat it as completely non-operating kind of gain. But all these gains are represented as a part of the income statement. Similarly, if these kind of things have resulted in a loss, they are represented as a part of losses, which means when I have to arrive at the net income finally, it is like I look at revenues minus whatever are the operating specific expenses, which are normal business related operations, any other income that I have got minus other expenses. So these are more operating specific expenses, which are core business operation specific, non-operating income, non-operating expenses, and any kind of gains minus losses. All these things put together is going to create my net income. Apart from that, we also see a few additional elements coming to minority interest in the income statement. I also see one more heading typically called as minority interest. Sometimes it's also called as non-controlling interest, especially if a particular firm has acquired another firm. Let's say A has acquired B, but not 100% of B. Let's say 80% of B has been acquired. Now, what the accounting rules simply say is the entire revenues and expenses of B will be clubbed into the income statement of A. Though A owns only 80% of B, the entire 100% of the revenues and expenses of B will be clubbed into the income statement of A. So which means even the profit wise 100% is clubbed into the income statement of A. But A actually owns only 80% of it, which means the remaining 20% of B, which is not owned by A, is typically called as the minority interest. The 20% of the profits of B for that particular year, which does not belong to A, is what we call as the minority interest. So what we do is, whatever is the final net income that comes by when I prepare the income statement by taking 100% of the revenues and expenses of B into A, whatever the net income that comes, from this net income, there is a subtraction of the minority interest of B. And finally, the overall final net income is going to come up. So this is one more element that could be present, especially if a company is having some kind of subsidiaries where the stake of the company is not 100%, is less than 100% stake. We will see that this kind of additional element for minority interest is also being present in the income statement. Then, coming to the various presentation mechanisms of this financial statements, we can talk about either a single step presentation wherein we just group all the revenues minus all the expenses and directly we come out to the net income. A simple presentation in one single step. Or we are coming out with a multi-step kind of a process where a bit of more detail out is happening. So here we first look at revenues. Instead of taking all the expenses, we take only cost of goods sold first. The difference will give me the gross profit. And from the gross profit, we deduct, let's say, selling, general, administrative, all operating related expenses. And and even the depreciation, because depreciation is also related to the operations, where we can finally arrive at operating profit or operating income. Then from this, the interest part is subtracted to arrive at income before tax. Then tax part is subtracted to typically come out with income, net income, or income from continuing operations. Then any discontinued, whatever the profit or loss on discontinued operations, and even the minority interest, if at all there is existing, that would be subtracted to typically arrive at the final net income. So this is a more detailed way of presentation of the income statement, which is generally followed by many organizations, a general presentation of the income statement wherein we denote the gross profit, which is majorly relating to the production cost or service costs, which are directly producing the revenue. So all those things are subtracted to arrive at the gross profit. Then I'm subtracting the operating costs. These two are operating because marketing costs, selling costs, administrative costs, depreciation, all these form the operating costs resulting in operating income. And then we are looking at financing, income tax, then minority interest, all these things subtracted to typically arrive at the net income. Sometimes in some languages the net income is also called as profit after tax, or in some cases it is used as earnings, and in some cases it's even used as bottom line. While the gross profit is typically called as your top line, which is more associated with the revenues, whereas the net income, which is more associated with the bottom line. So a basic understanding of the income statement of this form is very much necessary to typically evaluate any firm's income statement, right?